Yeah, I got a little bit of my neck is hurting a little bit from spiking up, spiking down. The VIX shot up to 65. Looking at the VIX now, it's all the way down at 15. Just to
Unbelievable.
provide some context, if they're watching this at some point in the future, this is actually where it did spike up to. So we're just going to get right into it. As an options trader, you're looking at spreads, you're looking to buy, you're looking to sell. How you handling the last 2 weeks?
Yeah, one of the things I love to talk about is volatility because it's really overlooked. A lot of option traders who are new to this just know how to buy calls or buy puts, and they know how to take maybe bullish and bearish positions. But one of the things they often overlook is volatility. And when volatility has that massive spike that you just illustrated, it is a tremendous opportunity to make a decent amount of money in a pretty short amount of time. So what you do is when volatility spikes like that, it's usually when at least you feel like everything's terrible, right? The world's coming to an end, all these crazy things are happening. But if you look at historic volatility, with the exception of maybe like the financial crisis or even the pandemic, maybe was elevated for quite some time. But under normal conditions, the VIX does tend to spike, and then it kind of falls off really, really fast, which you can see. You know what I mean? It almost looks like an EKG monitor. I like to joke around, like if you have like an elevated blood pressure and then it kind of calms down. That's kind of what the VIX does. So as an options trader, you could really take advantage of that. And what I mean by that is you become very quick in changing your strategy. And this is what we coach in our community all the time is, you have to switch to a more credit strategy. So what you'll do in the case when the VIX spikes like that is instead of just doing straight calls and puts, whether you're bullish or bearish doesn't matter. Your options premium, what you're paying for an option, gets expensive. And that's something that a lot of new traders don't understand. Doesn't matter what side you're on. So if your option premium is expensive because of volatility, you should be a net seller of options, which basically means credit spreads. So you go from a debit strategy, which is buying straight calls and puts or doing vertical spreads, to doing something called credit spreads. Or in the case of, if you want to do investing, cash secured puts. So those are kind of the two strategies that really work in an environment like that, where you could potentially get some really tremendous premium.
I think it is a big mistake that especially new options traders make. And again, I'm more on the equity side. My whole life has been on the stock side, but I know enough about options that there's a difference between you can afford it versus it's expensive.
Yeah, absolutely. Well, one of the most important things to just a simple calculation is what's your break even. If you're paying $5 if you buy an at the money option, which is closest to current price, and you pay, let's say, $5 for that, right? Let's say you buy a $100 call option and the current price is $100 and you pay $5, your break even is $105. That means your stock that you're speculating on needs to increase by 5% for you to make any money whatsoever. So understanding what you need to get to and in which time you need to get there is very important to debit trading when you're going long an option, whether it's put or call, doesn't even matter. But when volatility increases like that, the best thing to do is say, hey, volatility is high. Eventually it's going to compress. So let's go out a couple of months. Let's sell premium, a month out or what have you, and just let that volatility kind of compress and melt away. And what'll happen is when volatility compresses, which it usually does based on the chart that you just showed, that money goes in your pocket.
Is there a certain period of time where either the VIX moves a certain amount or you've captured a certain amount of premium that you close the trade out?
Yeah, I mean, you could have very specific rules to that. So as a normal credit trader, I know some traders that wait until the very moment of expiration, but to me, if it's close to the strike price, you're kind of taking on, you always have to think in terms of reward to risk. So if 90% of your premium is in your pocket because you did a credit trade, you might as well just close it out early. So I usually have, a lot of traders have 50% rules, 75% rules, or 90% rules, really depending on how many trades you have going on at the same time. So that has a lot to do with it as well. If you have one or two credit strategies, you could kind of milk it towards the end to 75 to 90%, but you should generally close it out because really, what are you going to get? A couple more pennies? What if there is a black swan event or some crazy headline news? The reward to risk profile starts to diminish after
one. Wait, and this is just a random question. If you start to wait too close to expiration to try and squeeze every penny of it out, does the liquidity change?
It could. It most certainly
could. To the next contract.
No, that's a great question, Pete. And what will happen too on the credit side is if it's way out of the money, where there's no willing buyers and no willing sellers, closing it out could become problematic. And that's one thing. But even if you are able to close it out, the market makers are going to get their pound of flesh. So they're going to charge you a ridiculous, maybe for a completely out of the money option, they'll still want to get at least 10 cents, right? So you'll end up not making as much as you'd like if you take control of the situation. We talk about this all the time in our coaching. We talk about money in motion and opportunity cost, right? So that's the way you have to kind of think about this too. If you're running a business and you have capital tied up in a certain trade and there's not much juice left in it, you might as well just close it out.
It's so funny you mention that, because one of the things that I found on the stock side is retail traders don't think enough about available capital. And because as a prop traders, and that was kind of my career for, the first 15, 17 years of my trading career, all you're obsessed with is having capital, because at that point you should have the skill to always be able to find a good idea to allocate it. And you want to be involved in the next move and the next move and the next move. And I think a big mistake, and hopefully everybody could learn from this right now, is retail traders don't think enough about tying capital up in dead or bad ideas.
Another thing to consider when you're a credit trader, especially if you have fairly wide strike selection, let's say you have a $5 or $10 strike difference between your long call and your short call, right? If you're doing a credit spread, what will happen is your risk is essentially in between the strikes. Because when you have a naked call, your risk is unlimited. But when you buy a call that's out of the money on top of it, you're covered up until that point. But the risk is really between the two strikes. That's your risk, right? So if you think about that, you have assignment risk. So if it's close to that, if it's below that long call but above that short call, you're going to have assignment risk. So that's another reason why you might want to consider closing it out early.
So speaking of assignment and that kind of stuff, somebody in the community the other day on the stock side was asking about the wheel strategy. And he was asking about specific conditions where it would be a more reliable strategy. I don't want to say profitable, but reliable strategy. Can you explain what the wheel strategy is, when it would be best to use, and when it might not be good to use?
Sure. The wheel strategy is a pretty cool strategy, actually. I like to use it. And this is more, again, on the investing side and a longer term, if you have a portfolio and you want to put money to work, this is a great strategy. So essentially what you do is, let's say you start off with a portfolio that's completely in cash, right? It has to be a decent amount of money because you're dealing with assignment and stuff like that. But let's say you want to invest in a bunch of ETFs because this is a long-term investment portfolio. What you essentially do is if the markets are close to all-time highs, or even if markets seem a little bit overheated at the moment, maybe they've recently made a new high and they're a little bit extended above their moving averages, instead of just going out and buying the indexes like a typical financial advisor would tell you to do, what you could do is sell puts. And when you sell puts, they are naked puts because you're selling cash secured puts, meaning you have the money in your account. You're willing to take assignment. This is the asterisk I want to kind of emphasize. You have to position size yourself. So, okay, if this happens, I'm willing to take on 100 shares of XYZ, whatever it might be, right? Now, what happens is in a higher volatility environment, that's great because you're taking in a nice premium. And basically, you're getting paid to leave a limit order. That's the way I like to describe it.
Wow, that's a great way to visualize it.
Because what you're saying is, I don't want to buy it here because the market just kind of ripped a little bit. But I'm okay with right here, maybe a 5% lower. So there are rules. I like to use certain deltas, and I only like to go out about a month at a time because you can't predict the future very well. So you're not getting really paid for your risk if you go out more than a month because the theta curve is not linear. So what you want to do is go out on a monthly basis, and you can be very methodical about it. You could go out every month and say, okay, I'm going to sell a put here. I'm going to sell a put there. I'm going to sell a put there at levels that I'm comfortable owning those stocks, XYZ, whatever it might be, right? Now, once you get assigned, you have to be okay with that. That's number one. And it never feels good to get assigned because usually it's when markets are declining, right? So the best way so you asked, when does a strategy work the best? It usually works pretty well in markets that are not correcting, but like a declining market where, you might get assigned, you might not, and you could kind of try your best to kind of take as much premium in as you can while markets are declining. Either way, at some point, you're going to get assigned. Okay. And here's where the wheel nickname comes in. Once you're assigned, you have to be okay with that. And this might take a month or two for markets to kind of level off and recover. But once that happens and you start getting some capital appreciation in your portfolio, now you own the stock, you could start considering selling covered calls, right? Once you own the stock and you're comfortable exiting a position, then you could sell covered calls against the positions that you were assigned. And then you rinse and repeat. So now you're buying at the lows, you're selling at the highs theoretically, you're getting premium if you miss. If you miss the strike zone, you just do it again next month. You know what I mean? And what you do is, as you eventually have a full portfolio and eventually you'll sell calls, and then you're going to get called away at higher levels. Now, what's the risk? The risk is obviously assignment risk, and the market continues to decline and you run out of bullets. That's
I'm just going to ask you that. What happens if you do get assigned and it continues to move down? Is there a strategy for either getting out or?
Well, what happens if you own an investment portfolio? You know what I mean? It's kind of the same thing. Then you could do you could do hedging strategies, right? You could do inverse ETF options. You can do all types of inverse strategies to kind of offset your long position once you're in a long position, right? But that's not part of the wheel strategy. That's just hedging, right?
Right. So actually, yeah, I'm thinking. I forgot you actually got assigned. So now it's just a straight out equity trade.
Now you just own a portfolio, right? So what do? You hedge, right? That's essentially what you would figure out a way to hedge. You'd figure out a way to do protective instead of cash secured puts. Then you would do protective puts, right? So then you could sell calls and make and generate income that way. But the logic behind all this that I'm saying is that the income that you generate from that premium income should kind of offset any losses you might have in the short term if you get assigned at maybe not the most optimal price, right? So it has a way of smoothing out your returns over time if it's done correctly. Now, the way to kind of blow this up, like I said, is if you get too greedy and you oversize, right? That's one way to blow yourself up. And then another way, and again, you do kind of miss the boat if the market rips, right? The market, the strategy doesn't work great if the market, it just keeps making new highs like it did like the last year, basically. It's challenging because you don't get assigned. You just keep selling puts at cheap premiums and you underperform in an environment like that. So this strategy does underperform in a rising market where the market keeps making new highs. So you just have to be aware of that and be okay with that. And selling calls, you have to be cool with getting rid of your position. So obviously, you could sell a call against an underwater position, but usually people don't want to do that.
Hey, it's Pete. John and I really want to thank you for being here today. You have all the choices in the world on YouTube right now to find out about stocks and options, but we want to continue to over deliver. And the only way we can do that is for you to let us know what you like. What kind of stocks and options training would you like for us to see on the channel? Best way for you to do that, give us a thumbs up. That tells us what we're doing is what you like. A little deeper, leave a comment. Let us know if you have any questions about what's on the video. If you want to take it even further and get personally coached by myself and John, click those links below in the description and see if coaching is right for you. Hope to see you soon. Thank you again. Interesting. So it's funny. I wasn't thinking of the wheel strategy because it's not really in my universe. I'm just straight up strategy. Yeah. And I was thinking about like when Chipotle actually split, they had the 50-to-1 split and it rallied a little bit over here. I remember as it started to roll over a little bit, I'm like, oh my gosh, this would be amazing if we can get the stock down in the 50s. Yep. And it actually traded down there. So that was probably a situation we could have used that scenario.
You could use the wheel strategy with individual stocks. It works great with portfolios too, or individual sectors as well. But yeah, individual stocks, you can do it too. If you were to sell puts in an environment like that, you might get assigned at that basing that you have, on the bottom there. And you know what? The stock really didn't move much lower. So you could have held the stock for a couple of weeks and then sold some calls against it at higher levels. And maybe if your timing wasn't perfect between all the puts that you sold and all the calls that you wrote against what you already owned, you probably would have done okay.
Yeah, it's so interesting how you perceive it, because I'm thinking like if you sell the puts below that for a while and you're collecting premium, you're basically getting paid to have your stop loss for when you eventually do get assigned.
Basically. So you have to be cool with
awesome.
You're getting paid to leave a limit order, and people like, how come nobody does this? I'm like, everybody does this. Nobody, but they don't teach it in school. They don't teach, they don't, It's just something that you have to understand the mechanics of, and obviously you have to have rules. The most important thing for any strategy is really, okay, well, how much do I really want to own? You don't want to overbuy. You know what I mean? You don't want to overextend yourself. That's the key. Don't get premium happy is what I tell people. You know, when you
so
use these,
I have actually seen people leverage themselves to the gill, and like some of the things that I see them doing, I'm like, that is absolutely crazy.
yeah, when you use credit strategies, it gets very easy to get premium happy, because what happens is you don't see the stocks in your portfolio. All you see is the short option positions. So you think you have all this money lying around, and you really don't. You have it kind of earmarked just in case, right? And that kind of gives people a false sense of, hey, I could do more contracts. And that's how they fall down that rabbit hole.
So we have now, obviously, we talked about the volatility that's unfolding in the market right now. Now, first, I want to give you ask you about the current conditions, because what I basically told everybody in the community today is that we just went from really bearish to catastrophic gap down to now we're in the midst of a 10-day rally where the volatility has just spiked in both directions. I'm not talking about the VIX volatility. I'm just talking price action volatility, which is a lot more my universe. So what I'm telling everybody right now, based on how I'm trading, is I'm telling everybody to scale out into this move to the upside. We don't really have any big economic data next week. But I think one of the problems or challenges that newer traders have is not making the distinction between the market conditions and what that means for the kind of profits we should be willing to accept. A month ago, 2 months ago, we were in a bull market that was lasting for a long time, and we kept making new all-time highs. And the conversation was around, we're going to keep adding to this trade as long as it keeps working. We're going to keep trailing this thing up as long as it, until it pulls back a certain amount. But that's not the current conditions. And I'm seeing coaching call questions where people are like, but that's not what we said last time. I'm like, yeah, because now it's not June anymore. It's a complete, this is a bear rally that has now gotten back into bull market territory, but it is not the same condition. Do you kind of teach the same way or trade the same way?
No, I definitely do, and I think that when a new community member does come on, they might try to give you like that aha question, like, "Hey, you said that 2 months ago." I'm like, "Yeah, but like,
I get people telling me what time in the video it was. Believe it or not.
Yeah, but like, dude, that was 2 months ago. You know what
Exactly.
I mean? Yeah. I mean, people have to realize that sentiment is very important with markets. So we talked about this, I think, last week. There's four major categories that kind of define sentiment, either in the long or the short term. It's technicals, it's fundamentals, it's macroeconomic, it's geopolitical. Any one of those four things can affect sentiment, and one of them tends to dominate usually in a given day, right? And then sometimes it'll dominate over the course of a couple of weeks. Like, it's all about inflation. It was all about inflation for all those weeks, and then it changed last. Then it changed last week or 2 weeks ago. Now it's all about, oh my God, recession, right? So like sometimes there's themes that
now we're back to it's fine.
Yeah, now the coast is clear, everything's great. We're back at the 15 moving average. Nothing to see here, folks, right? But the problem is we had housing data that came in really bad today, and we had great news yesterday. So economic data is still mixed. So I think we're losing steam here, and I think we did bounce a little bit, pretty strong. Usually, when you throw a ball hard against the floor, it bounces pretty high, right? And that's kind of what happened.
Yeah.
So the momentum is starting to fade a little from what I'm seeing. We probably will get a little bit of a rollover now. If we were to hold that 50-day moving average and stay there, let's say for a couple of days, and let's say we do nothing for a couple of days, we just kind of stay where we are. The longer we stay in this kind of area in the market, I think that we'll have a lower probability of testing those lows from August 5th, I think it was. We'll probably be range bound at that point until the next Fed meeting. Now, if we roll over and go even lower, right, the problem is that we'll have, then you might get enough momentum to the downside, which is bad. You know what I mean?
I think the start of this move, I mean, when the Nikkei crashed, obviously we blew past any expectations of how far it could go down, what they normally do. And I think obviously we talked about it 2 Mondays ago it was an aggressive buy, because if you think heading into that, everything was falling apart, and that was kind of like an exclamation point. But it was short covering. A lot of this rally was short covering. It wasn't so much people being brave and buying this massive dip with the Nikkei down 12.4%. The rally we're experiencing now is short covering. So what we're really looking for on the next move is, are new buyers stepping up, and do we go sideways? Do we go sideways, or do we have a move straight back down?
Yeah, I think time will tell.
Yeah.
As long as the longer we hold that 50-day, the more I think it'll probably tend to be more range bound. So we'll see. We'll see where we'll go from there. You know what I
I
mean?
see more range bound than I see hitting new all-time highs.
Yeah, I agree. I think at least until the Fed meeting. I mean, I don't think Powell's going to come in with a surprise. I think there'll be a meeting. We'll probably cut 25 basis points. He's a pretty conservative dude. It'll strike me. I'll be surprised if he goes 50. So I think that I think as long as that plays out, we'll probably be range bound until then.
I've actually been quoting you in the newsletter since last week because you said something that was really smart, because a lot of people like, he needs to do 50, he needs to do 50. And you're like, but what if he does 50 and it doesn't work and he doesn't have anything left?
Yeah, that's another thing to consider, because if you're on the recession camp, you need bullets, right? So you don't want to. If I was him, I wouldn't do 50. He doesn't need to do anything. I think 25 would be the more conservative approach, and I don't want to get in his head or anything. But if I was him, I would do 25 and kind of orchestrate or illustrate to people, hey, I'm willing to do more, but this is why I didn't do 50. I didn't do 50 because what if we run out of, I'll say it, what if we run out of bullets and there's a recession?
Yeah.
Because that could happen too. So we're teetering right now. Inflation is somewhat under control, but it's not completely contained. So you could get a flare up, you know what I mean? But then what happens if inflation's under control, they run out of bullets, and then we get a recession? So it's tough. We're in a tough spot right now, but overall the economy's fairly okay. You know what I mean? So although from a policy standpoint, he's in a little bit of a tough spot because everybody's putting pressure on him.
Yeah.
But I really wouldn't want his job right now. That's for
all the other countries have cut already. We're the only one that hasn't really right now. That's of significance.
And I find that actually encouraging, and I'll tell you why. Because normally when they orchestrate at the same time, it shows that there's worry, there's global concern about an economic crisis of some kind. But the fact that they're all kind of like a bunch of stray cats doing their own thing is actually encouraging. It means they're having their own thought process. They're worried about their own individual regions and stuff like that. And there doesn't seem to be a global contagion risk or any kind of worry there, which I find encouraging. So that actually is good. So I'm cool with him just doing 25 and maybe just telling people, hey, listen, this is why. I want to be cautious. It's better to be err on the side of caution, watch inflation drift down nice and slowly, than to not have a possible no bullets for a recession situation.
Consider we expected to have 6 rate cuts coming into 2024. We haven't had one yet. Do you think this is priced in already?
Do I think it's priced in already? A little bit. I mean, it's close. I think it's 90% or something like that. It pretty much is. So I think it's not going to be a major event on the day of. I think it'll just be an issue where it gets past us. You know what I mean? And then you'll have earnings season again. And I think that's when people will more focus on that. But that's really what it's all about. I think we'll be range bound until that's kind of behind us. Once we're in a lower interest rate environment, the housing data was not very encouraging today. I think if we lower rates, if you see mortgage rates drop, the spread between the 30-year and the Fed fund rate, if that starts to narrow, I think that'll be encouraging. That's something I think people are really watching closely too. And that'll be something I think that'll be, pro economy. It'll kind of help quell inflation fears.
So I want to hit you with something funny, actually, that was in the YouTube comments from our last video, which basically is, pretty much we were like over here in the market. Like that was where we ended our last video. We had somebody say, LOL, these guys are perma bears.
Where were we?
We're like right here. This is like where we finished, like at this point. And that was the analysis that we had on where the market was unfolding. We had somebody say that these guys are perma bears because we were reading the price action of the market going down for 3 weeks.
Well, I just do what's in front of me. I don't consider myself a perma bull or a perma bear.
I agree. I completely agree.
I would highly recommend whatever individual said that, go back and watch all of our videos.
Right.
Because, that's
not the case.
Yeah, not the case. Not at all. If anything, I think the economy is doing pretty well. And I think that this bounce was encouraging. But I do think now that it bounced pretty hard, it's at the 50-day moving average. And if it stays up here, that's even more encouraging. But I do anticipate a little bit of a rollover. And that doesn't mean I'm a bear. It just means, hey, listen, we bounced off our lows pretty hard.
Yeah, we don't have any really massive economic data next week. Like we don't have non-farm payrolls, GDP, or anything like that. So I would say that, and which is what I have been saying to everybody in the community, moving up trailing stop losses in the midst of this 10-day rally, looking to be a little bit more aggressive to take some money off the table. We are only 2.5% from all-time highs in the SPY, so it's going to be really interesting. I think next week is likely to be sideways, and we'll need to be a little bit more stock specific.
Yeah, it'll be stock and sector specific for sure. Will the defensive risk off sectors still dominate, or will tech kind of rally back like it did this week? Will it continue?
Ooh, tech was on fire this week. Tech and consumer cyclical actually bounced back this week too.
Yeah, absolutely. So honestly, I think if we hold the 50 and roll over a little bit, it might be a buying opportunity, might be an entry point. I wouldn't buy it up here. You know what I mean?
Not at all.
But I think that depending on price action in the next couple of days, and I'd like to see how aggressive the rollover is. If it's mild, then I would be a buyer of those sectors. But in the meantime, it's going to be stock and sector very specific for sure.
Volume on the next pause, which will likely be next week, will tell a lot of what the next move is going to be.
Absolutely. And, you know, and look at what month we're in, you know what I mean? So just from a calendar perspective, we're in August. So don't expect, you can't expect too many miracles, you know, in the next couple of weeks.
Yeah. When I had my trading office in New York City, obviously around the world, people might not necessarily know this, but as we started to get closer to the back half of August, the whole conversation was anybody was in the Hamptons at that point.
Yeah. So what are we getting for lunch? You know what I mean? It gets quieter. And from an option standpoint, it's great because you could kind of just do more credit stuff like I talked about earlier. You could do targeted butterflies into certain targets if you have certain targets in mind for new specific events or earnings related stuff, or you could just sit back and kind of just lower your positions and see how things unfold. I think here is kind of pivotal. If we're at the 50-day, that's kind of my line in the sand. If we stay here and we start to either drift higher or stay where we are, it'll give me more confidence that we're not going to test the lows from August 5th. We're probably going to go higher. So I will use any rollover as an entry point.
And now we actually have the 50-period moving average as support, which is crazy. It didn't even look like we were going to come even close to that 2 weeks ago.
Yeah. So as support, that's my line in the sand. Now the 20 is still below the 50. So when you have the 20 below the 50, that's not encouraging. So perma bear no, but I just follow what the charts are telling me, man.
Yeah, and that's actually why it's so important to also use price action, not just moving averages, because moving averages are kind of behind the scene right now. They're pointing down while price is ripping up, and a lot of people are having a challenge right now with a bullish rally and a bearish tape, so to speak.
Yeah, that's true. It's called the bear rally until you're proven otherwise.
Exactly. All right, John, thank you so much for your time. I will speak to you soon.
All right, Pete, you have a wonderful rest of your week.
You too. Thank you.
Take care.